Hi, I'm Zach from Accounting for Actors, and today I'm going to walk you through understanding payment on account and what this means in the self-assessment system. Also, please don't be concerned by my strong American accent and those crisp dollar bills you might see in this video. A4A is still a British company, and all of our advice corresponds to British tax law. Alright, let's get started. Okay, so what is payment on account? Payment on account, or what maybe should be called payment up front, means that the first time that you go over £1,000 in what you owe for a tax year, the system will make you pay not only the tax due for the historical year, but also the same again up front for the next year. So half on January 31st and half on July 31st. It is asking you in effect to catch up with the sole traders already in the system. This means that if you magically earned exactly the same amount year after year, you would always make exactly the same payments on January 31st and July 31st every year. That is until you get to the last every year of your business, in which there'll be no tax to pay because you'll already have paid it up front. Just remember though, to retire before you die or the benefit is entirely wasted. Alright, let's go through an example together so you can see how payment on account works in practice. Let's say you earned around £20,000 in profit in the 2023-2024 tax year, and your tax and national insurance bill for that year came to around £2,000. That means on January 31st, 2025, you must pay not only that £2,000, but also £1,000 on account. And then on July 31st, 2025, you pay the other £1,000 on account. If you made the exact same profit every year after that, you would always then pay £1,000 every January and £1,000 every July. Except that in reality, of course, you don't, so these numbers go up and down every year. Once you're in the payment on account system, it becomes an even better idea to file early in the year, say in May or June, because then, if the July 31st payment is set too high, it is adjusted down before you actually pay it. When the time comes to file your next return, there is some scope to reduce your payment on account if you expect to earn significantly less in that current tax year than your previous year. However, there is some risk to this. If you underestimate and owe more tax, HMRC will charge interest on the unpaid amount. That being said, the interest rate is low. You can mitigate this risk by filing your return early, say in May or June of that year, which means that the period on which any interest may be due is short. Of course, you don't have to reduce your payment on account at all. In fact, you can stick to the calculated figures and run the opposite risk. That of paying more on January 31st than you strictly need to, and then having to wait till the next year's filing to get any overpayment back. This is really just a good test of your individual psychology and preference. Some people are keen to avoid the risk of underpaying, while others are keen to avoid the opposite, of overpayment. I hope this has helped you answer any questions you had on payment on account and how it works. If you have any questions about this still, or any other questions about accounting, please reach out to me and others here at Accounting for Actors. Thank you.